Now, picking it up with part three, there are then numeric models, ways to assess whether your project should be selected by this C-suite, right? We largely are going to look at profitability, right? We might look at a scoring mechanism or some other approaches as referenced in the book. So feel free to look there for additional information as I know you're reading it. So some models that look at costs or revenues include, but are not limited to, payback period and discounted cash flow. Now, what I wanted to mention on this slide is that basically there are two ways to compare a project, right? It's financial measures. One, and we'll just jump to the bottom of the slide, is called constrained optimization methods. These are linear mathematical models that you as a project manager would never be expected to do. But you need to be aware of them to ask your cost manager or your finance office if they have done any, or as you're leafing through the business case, you'd look for those constrained optimization methods. Now, and those may involve complex linear or nonlinear programming or dynamic or integer mathematical calculations. Now, I wanted to then get to the top, which is called benefits measurement. Those are comparison methods, right? And I cover there 4 really comparison methods. There's a murder board, right? Put a bunch of equals in a room, put out the document, and have everybody rip it up and criticize it, right? That's a murder board. Or a peer review. I may build a business case and hand it to a peer for a review, peer review. We'll look at scoring models in a minute. That's just a weighted matrix. And then there are economic models, including present value, future value, and I give the formulas for those. If you want, present value equals future value times 1 plus the interest rate, and that 1 plus interest rate to the nth power, which is the number of time periods, quarters, years that we're looking at. Future value would be algebraically the opposite, undone. Future value equals present value times 1 plus the interest rate, and that 1 plus the interest rate to the nth power, again, the number of time periods. And so then you have net present value, return on investment. We talk about ROI all the time. That's the benefit divided by the return on investment. It's really a measure of efficiency and performance. IRR, internal rate of return. That's really like an interest rate. You'd say, well, a company could take this $1 million, invest in your project, but if it took this $1 million and put it in the bank, your project is going to return, we think, 29%. The bank, we think, will return 6%, right? Which are you going to go for? Payback period, we're going to talk about in depth in a minute. But basically, if I loan you $10, when do I want it back? Well, I want it back now. But that's not reasonable. You just asked for it. So I like you. Hey, tomorrow, if you see me, you can get it back to me, right? But we want it back sooner rather than later. And then there's opportunity costs. Opportunity costs are a way of saying, there we go, just slide a little bit. Opportunity costs are a way of saying, I have project A or project B. If I pick A, I lose the opportunity B. It's one or the other. And so B becomes my opportunity cost, the cost of an opportunity that I will never take advantage of, right? And that's opportunity cost. Now, in the end, here's kind of a summary. And this is all I ask you to do if you use economic factors in your Panama Canal paper, is some bigger is better. If you have a bigger present value, you choose that one. If you have a bigger net present value, if you have bigger internal rate of return or benefit cost ratio or return on investment. So it's all about taking the time value of money is kind of what we're talking about here. Taking big money and over time turning it, little money rather, and over time and turning it into bigger money. Now, there are two that are smaller is better. One is opportunity cost. The cost of the project you're choosing not to do, That's your opportunity cost. You want that to be smaller, so you maximize your benefits with the project you chose. The other would be payback period. Smaller is better. I want my money back sooner rather than later, right? So smaller is better. The other ones on top, bigger is better. All right, that's kind of a good summary. And that's the level of detail I'd ask you to, if you use these in the paper, just to assess. I also like to talk sunk costs, right? Sunk costs are not a reason to stop doing a project. Because it's money that you can't get back, that you've already put into it. But the real question as a project manager, and I give you an example here on how the math might work, right? So the answer is actually none, right? In this example, because the sunk cost, that's not the question to a project manager. The question is, are the objectives still achievable? And are they tied to the corporate strategy, right? So do I still have alignment with the top of the company, and can I still achieve them? Imagine the first Apple iPad did not come out on time, I would surmise. I don't know that for a fact, actually, but I would not think so. I mean, they're having to invent apps, and what's an app? And what should an app do? And where do you get an app? Well, now we got to invent an app store, and then we got to do security controls, and all that is very interesting. So sunk costs is not a reason by themselves to cancel a project. Okay, I also like to touch on, in this high-level approach, you want to consider accounting, for example. So in accounting, there's a couple of terms to be aware of. One is working capital, which in general, and I'm not an accountant, right? I'm a project manager. I'm a generalist of most things, right? But I integrate everything. So working capital is my current assets minus current liabilities. I like to have a sense of that, because that tells me the money that my project, my company may have available to invest in my project, right? And so a sense of that tells me what access I can get for capital later. In addition, depreciation, right? Because if I buy an asset for my project, if I can depreciate it, I want some of that cost back to help funding my project. And depreciation generally falls into two types: straight line, which is just basically the same amount every year, or accelerated depreciation. And in accelerated depreciation, it comes also in two forms: double declining balance and sum of years digits. Beyond this course, but very interesting if you wanted to look them up. So the score, then we can also do a scoring model, right? Which is going to mimic how we actually evaluate investments. And a weighted model is an excellent way to go, right? It allows for multiple objectives to be considered. It's easily adaptable, and it's not biased toward the short run like a profitability model might be. So here's just an example of a scoring matrix that I did, right? You have your critical success factors along the top. I'm buying a car, a used car, and I want to consider cost, safety, and the mileage, right? And then I pick 3 cars, and I'm going to, I give them each a weight, because cost is most important to me. I don't have a lot of money. And then I've got a family, so safety is also very important to me. Miles, it's interesting, and I know it's an indicator, but not so much, because I've got a friend down the street. He's a mechanic, gives me everything at cost, great guy. We've known each other since grade school, right? And so that's how I weighted that. And then I will assess car 1 based on cost, safety, and miles, and give it points, car 2 and car 3, and I total them up. And based on this weighted assessment, I should choose used car number 3. So the weighted scoring model, right, just kind of goes through this. And this is kind of a verbal summary of what we just did, okay? So the advantages of a scoring model, you can see that it allowed multiple criteria, right? My critical success factors, my weight of them, etc. It's structurally simple, right? It's part of that reflective thinking process, which is good for every project manager. Every project manager analyzes, right? So it's perfect. And it's easily altered, right? I could change the weights, or I could change the criteria, and it allows for that sensitivity analysis. Okay, so payback period we already talked about, but basically shorter is better. The book does refer, here's a formula, the project cost divided by the annual cash flow. So if the project costs me 100 grand and my cash flow is 25 grand, it's going to take me 4 periods, could be quarters, years, decades, whatever, to get my money back, right? It's good to know, okay? So just flipping through a couple of the slides I didn't want to show. There we go. Here is one of the, there's discovery-driven planning, and that's addressed adequately in the book, so I ask you to refer there. What I like to talk about are 2 terms. One is progressive elaboration and rolling wave planning. So progressive elaboration means in project management, even though we're doing this detailed planning, we know by definition a project is unique, right? So it's never been done before this way, this time. So with the current constraints, assumptions, etc., stakeholders. So we will progressively elaborate over the life of the project, right? And so though we build a project so that it won't change in detail, we expect changes due to progressive elaboration. And there's also rolling wave planning, where I plan the near term in detail because I know the near term, and I plan at a high level the long term because I just don't know yet. That's a rolling wave planning is the term. So those are great terms to reference in your Panama Canal paper, I would offer. And then we're going to touch on risk considerations and project management. Project selection. So both costs and benefits at this point are uncertain. And this is what makes projects risky, right? The benefits are more certain than costs, but still both uncertain. There are many ways of dealing with risk that you can do. We're going to choose an approach here later on in this course. And we can make estimates about the probability of the outcomes. Remember, a risk is involved with probability and impact, both the threats and the opportunities. How do I eliminate or mitigate a threat, the probability and or impact, and how do I maximize or make happen a project management risk opportunity, right? Both are uncertainties at this point. And the probabilities can be subjective, right? We also will consider in this whole mechanism the timing, what will be accomplished, what are the other risks that result from implementing these risks, etc. So project portfolio management, that's where I'm going to pick up because that'll take a few minutes and that'll be the last session for this week as you continue your reading, discussion work, etc. Thank you.